All right, so then the next big section, if you will, can be its own financial statement. So the income statement is where we've left. We don't talk about this next section in intro. We leave you with just the income statement in intro, sales revenue, taking off COGS. That gives me gross profit, operating expenses, subtract those. That gives me income from operations. This is an easy, what I'm doing right here is an easy drill. If you're learning these things, just make yourself write them out like 5 times and then come back 10 minutes later, write it again until it's just all up in your head. Then we add or subtract. We always subtract that operating expense except for a couple. There's a lot of negatives and positives in my non-operating income or other income. And then we're gonna forgo the disc ops here. Um, we're just gonna get pre-tax, take out the tax expense, and that gives me net income. Of course, if we had discontinued operations, they would have to go in between, they would go right here. So if we did have them, if disc ops exist, here is their insertion point. Because disc ops, remember, this is the thing that I usually find students forget is that disc ops come in before net income. So they sneak in before net income and ultimately affect the net income of the company. Now, what follows or what can follow on the same statement sometimes is comprehensive income. So comprehensive income, if it's listed as part of the income statement, and I'm just shorthanding comprehensive, comp income, is the ultimate final subtotal if it's on the income statement. And we arrive at it after adding or subtracting other comprehensive income items. These are always going to be net of tax, like our disc ops, because they follow net income, which clearly always follows tax expense. Remember, this tax expense only includes those things above it. It does not include the items below it. So it does not include disc ops when they exist. It does not include other comprehensive income. And so we have to separately back those numbers out of our pre-tax amounts. Now, net income, remember in the closing process, net income is closed by closing entries into retained earnings. Right? If the net income is a profit, then net income is over here when it's greater than zero. If net income is less than zero, it's entered in as a debit because the income summary, when we close it, will force a debit into retained earnings. But one way or the other, it is incorporated into my retained earnings with closing entries. Other comprehensive income is closed into AOCI, accumulated other comprehensive income. And we talked a little bit about this account, barely touched upon it in our balance sheet chapter. And I said, hey, it's a lot like retained earnings. Just like retained earnings, it can have a debit or credit balance. And just like retained earnings, it tracks in the accumulation of, in this case, OCI items over time. So any amount of OCI, gain or loss, is put into this account. Gains are closed and they end up closing as um, credits to AOCI, and losses end up being closed as debits to AOCI. And whichever is greater, ACOA, OCI gains or losses, that gives us a balance, right? If the overall losses are more than the gains, over time we'll have a debit balance. If the opposite is true, we have more OCI gains than losses, we'll have a credit balance. Okay. So structurally, this is one way of reporting comprehensive income is to have a income statement that includes everything an income statement does and then tax on the comprehensive income. So this is the income statement method for disclosing disc ops. I'm not sorry, disc ops, OCI and comprehensive income, CI. The more popular inclusion, it gets its own other comprehensive income statement separate from the income statement. Usually it follows the income statement in presentation, where rather than having the entire income statement, we just start with the net income derived from the income statement. So it starts with net income, adds or subtracts OCI gains and losses that are all always net of tax, and then derives comprehensive income from that. So it's a very short statement. Um, doesn't have a whole lot going on. Okay. Also does not have a lot of investor interest. Okay. Investors mostly are going to be interested in the net income on the income statement, either the net income or the income from operations or the gross profit. These are the things that attract the investors, the typical investor's eye. This amount is not heavily used by investors for valuation, even though it sounds really holistic, right? Comprehensive income. It's telling me the whole story, the comprehensive story. But it turns out that the whole story can sometimes introduce noise in my ability to predict future income. And in particular, OCI gains and losses. If you watch my lecture and look at some of the questions in the chapter 4 problem set, these OCI gains and losses are usually transitory. And if they're transitory, that means that they don't have much earnings quality. So they are not high earnings quality. And what does that mean? It means high earnings quality means you can use this income piece to predict what's going to happen in the future. But because these are transitory, that means that gains this period might be losses the next. That means we might have run up, a huge, maybe like one of our investments had a fallout and it was recorded as an unrealized loss. And that cost us $100 million this period. But it might turn around and go back to its normal price level in the next period, which would totally erase that loss. So that makes this measure noisy. It has $100 million loss that's going to be gone the next period. It's not good for predicting what's going on in the future. This is a big reason why we put the transactions that we do as OCI gains and losses. And you absolutely have to know the four transactions that are classified here. One is unrealized gain or loss. I'm just going to shorthand GRL, on AFS securities. So if something is available for sale security, we haven't sold it, it's unrealized, which means we're still holding it. The unrealized portion means if we did sell it, we would get a gain, or if we did sell it, we would get a loss. So right now it's in a gain or a loss position, but we haven't sold it yet, right? This is something we do track, but because it's noisy, we put it down here in OCI. Another item that has tons of noise is foreign currency translations. So any gains or losses coming from the movement of foreign currencies. How does this get into corporate reporting? Well, companies obviously have international assets. Those international assets are valued in their respective domestic dollars. So maybe they're in yen or renminbi or rupees or whatever it might be, right? Euros. As well, when we report our operations as a US company with these international assets, we have to convert those foreign currencies into US dollars. Well, the strength of the dollar on the day of reporting will determine some movement in the value of those items. We have to report any gains or losses from the dollar either gaining strength or losing strength against those currencies. Once we do the translation into dollars, those currencies are so volatile. Currency markets are notoriously volatile. Therefore, they are excluded from net income, included as other gains or losses. And then the final two, gains or losses from cash flow hedges, which cash flow hedge accounting is very hard, complex. Understand that if we have cash flow hedges, any gains or losses from those also transitory are contained in OCI. And then finally, any unrecognized pension costs also put in OCI. These are the four. There's not many that go in for predominant OCI transactions. And what they have the most in common is investors don't care about them because they're transitory. They don't have high earnings quality. We want to exclude them from net income. We put them in below net income and develop this measure, which sounds like it would be very useful because it's comprehensive, but ultimately it's not, right? So one thing I really want you to get a grip for from this discussion of acronyms that are just one letter off, mind you, because we have comprehensive income, we have other comprehensive income, and then we have accumulated other comprehensive income, right? So to me, it really all starts off with OCI. These are those four transactions. These are individual income items, individual gains and losses, excluded from net income due to volatility. Right? It makes income a less predictive measure, so we want to exclude them. They are closed into AOCI, and AOCI is a balance sheet account similar to retained earnings that accumulates OCI gains and losses. So these are income statement gains and losses, expenses, revenues, excluded from net income. We close them into an equity account. It's this balance sheet account, which is, I should have noted, an equity account that just serves the purpose of accumulating all of this stuff over time. And then our comprehensive income is the total we arrive at after we subtract OCI from net income. So it's a total on the income statement derived from net income plus or minus OCI. So they're all related. They all are defined by OCI in one way or another. And then OCI is just these four transactions that we have flagged under GAAP as not providing significant insights into the operations of the company, and therefore should not be included in net income if we want net income to be an instructive, predictive measure of profitability.